capital gains push you into a higher tax bracket. That's exactly what we're going to cover today and look at a real life scenario on the impact of adding capital gains to earned income and how that might impact your overall tax bracket. Hi, I'm Travis Gatzmeyer, certified financial planner and founder of Kinetics Financial Planning. I work primarily with entrepreneurs and stock compensated professionals on building wealth and reducing their lifetime taxes. So let's dive into today's topic. And we're going to look at a married filing joint situation where earned income is about $300,000. And then we're going to add on some capital gains to see how that impacts your tax rate. So in this example here, we have total income of $300,000. And after deductions, which is the standard deduction in this case, we have taxable income of about $270,000. Now, as you're probably familiar with, that $270,000 runs through the marginal tax brackets and spits out your tax liability, which is $51,000 in this scenario. It's always important to know that you're not actually taxed on 24% if you fall in the 24% tax bracket. Your income runs through the different tax rates in the marginal tax brackets, which are 10, 12, 22, and 24%. That all averages out in this taxpayer's situation to about 17%. Even though they're in the 24% bracket, their average tax rate is 17%. So we're going to take that same $300,000 of earned income, but we're going to add $200,000 of capital gains to it. In this scenario, $200,000 of capital gains increases the total income to $500,000. Same standard deduction, and we have total taxable income, which is the amount of income that you're taxed on, at $470,000. As you can see, that brings our tax bill up a little bit to $89,000. But how is this all taxed? Even though we added $200,000 of capital gains, you can still see in the marginal tax bracket that's still the same at $270,000. So adding $200,000 of long-term capital gains did not impact our marginal tax bracket. So it didn't push us into another tax bracket. And what's important to know is long-term capital gains are actually taxed on their own tax bracket. We'll see the tax brackets for long-term capital gains. And you see 0%, 15%, and 20%. And in this scenario, how you determine where you fall in the long-term capital gains is you simply take your earned income, which was $300,000, plus your capital gains, which was $200,000. And then you take out those deductions like the standard deduction that we talked about. And that comes out to $470,000, which means you fall in the 15% tax bracket, which that $200,000 of capital gains would be taxed at 15%. As you can see, adding long-term capital gains is taxed on its own bracket, but the total income determines where you are taxed in a long-term capital gains standpoint. So there you have it. Long-term capital gains does not actually push you into a higher tax bracket. However, long-term capital gains sits on top of ordinary income to determine your long-term capital gains tax bracket. If you found this video helpful, please comment below, like it, and even subscribe to the channel if you want to get notifications when new videos come out.